Yeah. I mean, and if you're in a 22% income tax bracket, $1 million minus 22%, as you make piecemeal withdrawals out of that. Yep. Again, yeah, a million on paper might not be a million when you walk into the bank to make the deposit.
And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial investment and retirement future. He is president and founder of McIntire Retirement Services. Chris McIntire here with us. Always appreciate the guidance and perspective, Chris. And as we are in the holiday season, spending a lot of money, today going to be talking about our three biggest expenses in retirement, certainly things we need to plan for.
Absolutely. We all have big expenses while we're working, big expenses while we're retiring. So it'll be good to talk about this today.
Yeah, we've got a plan for those big expenses, Chris. The only way for our expenses not to catastrophically outpace our income producing ability and our assets is to know and plan effectively for them, to identify them and then to prepare to address those expenses ahead of time. So we'll be talking about the three biggest ones that you will face, ladies and gentlemen. And of course, if you would like to get that plan put together, your game plan for retirement, pick up the phone and give McIntire Retirement Services and Chris McIntire a call, 800-868-1194. That's 800-868-1194. 800-868-1194. And Chris, you have not seen retirement only one time. You've seen it many, many, many times over. And adding up all of the costs, retirement can tend to be pretty expensive.
Yeah, it certainly can. You need to know what's coming in versus what's going out. The basic elements here, it's Algebra 101, solving for the unknown. So my math teachers would be happy I gave algebra a shot there. As we go through retirement and people listening to the show today, they're used to putting money into investments. They're not used to taking money out of it. So it is an emotional transition for everybody as well. So hopefully we give them some good clarity on today's show.
Well, we will be talking about that as well as putting the plan together. But again, if you've got questions, concerns, pick up the phone, give a call, 800-868-1194, 800-868-1194. Before we get into it, Chris, I do want to kind of get your pulse, a quick check on everybody seems to have this perception or belief, prediction about what the market is going to do moving into next year with a different party in power, with Trump in the White House, with the Republicans controlling Congress. There seems to be some expectation. Can we say with any degree of certainty what the market is going to do next year?
Oh, absolutely not. There's so many forces at play, and even the best predictors, if you will, miss it handily. And like this year, a tremendous year for the stock market, all in all, wasn't predicted by any stretch of the imagination, right? Despite very high inflation rates and whatnot. Everybody thought when in 2022 when they raised rates 11 times, historically that puts you into a pretty decent, let's say, recessionary type part of the economic cycle. That didn't happen. So, a lot of things, just there's some resiliency in the market right now. The labor market is strong. And despite, the politics of today, here we are closing out 2024 in a very good spot from where we started in 2023.
Yeah, but if we did a year in review here, Chris, at the beginning of this year, everybody I feel like was saying recession is coming, recession is coming. How are we going to thwart this and address this recession that's coming? They talked about that with like almost certainty, it seemed like, and then it ends up being a banner year, two in a row, and kind of a record for the returns the last two consecutive years.
Absolutely, and despite political gridlock and lots of geopolitical forces out there. If we look at the Middle East and the Russia-Ukraine factor, and that makes the United States pretty attractive. We're a couple of oceans away from some of that stuff landing on our front door. Obviously we have some immigration issues that we're going to be dealing with here going into next year, and there's a certain economics to all of that. Those people that have come into the country need care and food and shelter and whatnot. And it's different when there's a couple 100,000, when there's 12 million that have come in. That can be a strain. So we will see strain on social services and things like that maybe we hadn't anticipated, right? I mean, as these things start to snowball a little bit, it'll be interesting to see how 2024 plays out, and that's about as political as I'm going to get today, buddy.
But absolutely no certainty nor guarantees about the market, which is why, Chris, as we look at conditions as they are now, with the markets being at all-time highs or thereabouts within the range, with interest rates still being attractive, it really does make it a good time to plan, to put together the pieces of the puzzle, bring all of the investments, all of the accounts, all of the retirement opportunities that we have to look at Social Security, to look at taxes. Taxes are historically low. To bring all of those pieces together and really formulate a solid plan for retirement.
Yes, absolutely. And, encompassing the entire picture is very important, because some folks that are going into retirement, they're going to do some things they've never done before. They're going to be spending money like they haven't done before. We're going to take our trips. We're going to go down to Florida or wherever for 3 months during the winter, things we hadn't done before. It probably means they may eat out a lot more as well, right? When you're traveling, there are a lot of expenses. And, let's be honest, food is something that's very expensive right now. I think our inflationary, cycle is really taken its toll on the food that we purchase for
Mm-hmm.
sure. And, that's a big staple of the budget, right? We all have to eat.
Yeah. Well, how do you know if you've saved enough, right? You've got to address the expenses. How do you make it last? How do you make sure that you won't run out of money and be forced to dramatically change your lifestyle? It all comes down to that written plan, ladies and gentlemen, the game plan for retirement that takes all the expenses into account. And you will have some that predictably, you will have some surprises, you will have some minor expenses, you will have some large expenses. And today we're going to talk about the three biggest expenses in retirement, how to plan to control them. And oftentimes, these items are not line items on a budget. And so we've really got to address these. We need to understand these and plan for them, the three biggest expenses in retirement. And that's exactly what Chris McIntire does each and every day there at McIntire Retirement Services. He helps individuals, proactive savers, investors, and planners address these expenses and design the game plan for retirement. And if you would like to take advantage, no cost, no obligation, to get your custom, individual, and specific game plan for retirement put together, pick up the phone, give a call, 800-868-1194, or you can visit online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. So, Chris, let's start off with our list of three. Our largest known expense in retirement is likely going to be taxes. Is that a factor of the way that we have been taught to save and prepare for retirement?
That's a great question, Peter. And yeah, without a doubt, because, most of the people retiring today have been putting money into 401ks if they work for a company, or self-employed people put money into SEP IRAs typically, or simple IRAs. So for most folks, they were wanting to lower their taxes over the course of their lifetime. They went and did their taxes, and on April 15th, the accountant says, well, you could lower your taxes if you put $7,000 into your IRA account. Okay. Now we fast forward 25, 30, 35 years, and all of a sudden they've got this big pile of money that they've never paid any tax on, and they will start paying taxes on it as they make their withdrawals. Those taxes have income taxes, have other ramifications, like how much of your Social Security benefit then gets treated for income tax related items. How much are your Medicare premiums going to be because of income tax related items? What is the rate on your capital gains tax going to be because of your income tax related items? So, we work with lots of people that said, man, if I'd have known all of this, I'd have paid the taxes up front and put it into a Roth IRA. That's what is very common nowadays.
Yeah, but that wasn't around for the majority of the now retiring or even already retired generation's career, right? The Roth relatively in the grand scheme of things, newer version of a retirement account, right?
Correct. Yeah, I want to say it was 1985 when Senator Roth, brought that legislation forward and got it put into play. But let's be honest, that's what 40, almost 40 years ago now. So they have been around long enough. People should, and again, we do see a lot more money in Roth IRAs, in the last 5 years than we certainly did 5 years previous.
Yeah.
And income tax rates are lower right now, not higher. So we've done things on the show where we talk about, well, look, where could taxes be, where could they not be? And with the incoming Trump administration and the Republicans having all three parts of the executive branches there, the House, the Senate, and the presidency, you would think there's probably better odds of having those tax cuts that President Trump put in place in 2016 will get extended, right? I would certainly think so. The big factor there is the 12% tax bracket is most likely not going to go to 15%. It will most likely stay at 12%, Peter.
Yeah, but you mentioned taxes have come down. They were higher. Now they're lower. We're at a historically low point. So for all of those kicking themselves because they did not take advantage of the Roth, Chris, that may not have been a mistake while we were earning an income and a paycheck, which may in all likelihood have been higher during our working career than what our expenses are in retirement. It's just that once we cross that threshold and our expenses are about the lowest that they're going to be for the duration of our lifetime, the day after retirement, especially, kind of a key opportunity to really begin effective tax planning.
Sure. Yeah. We mentioned Roth IRAs introduced in 1985. In 1986, the income tax rate on $68,400 was and above was 38%. And I know there are brackets above that, but just, today you'd be in a 37% tax bracket on income above 600,000. So,
Yeah.
Rates have certainly, tax rates have certainly come down, much more favorable environment. And that's probably why we see a lot more money in the Roth IRA side. And, look, we're not out here telling everybody, hey, cash in your IRAs and roll them into Roth IRAs. Sometimes you can do that in bits and pieces over a multi-year type plan. And that would be good tax efficiency planning. But to lower that number one expense that you may have in your retirement, and you can also pass the assets on income tax free to your children who may be in a very high income tax bracket. So, number of different measures there. We talk about this all throughout 2024.
And there may be a possibility, maybe a little better possibility now that low tax rates could be extended. But as tax laws stand now today, that's what we plan based around. And as they stand right now, January 1, 2026, we don't have these low tax rates forever and ever on the books. They are slated to go up. Taxes don't stop in retirement. Chris, the IRS is not going to forget about those tax deferred dollars. They've got a plan to collect the taxes owed off of those. And therefore, for retirees, certainly something that we have to plan around. And a lot of people make what we've termed the gross planning mistake. They look at the lump sum and forget to factor in that tax bill.
Yeah, absolutely. And, again, knowing where those tax brackets fall, working with a qualified CPA planner and an investment advisor that pays attention to the taxes can be very key to being tax efficient. Maybe not tax free, but tax efficient. I've got money in IRA accounts, money in Roth IRA accounts, money in non-IRA accounts, and money in life insurance policies. So again, 4 different buckets you could say that we utilize.
Yeah. I heard financial guru Dave Ramsey. He was talking on his Millionaires themed show, and somebody called in. They were in their late 40s, if I recall correctly, and basically asking the question, Dave, am I a millionaire? And Dave said, well, yes, obviously, it's what you have minus what you owe. And if you've got $1 million in your 401k, then obviously you're a millionaire. That's just math. And I'm thinking to myself, well, wait a minute, Dave. There are taxes owed out of that. That is a bill, and if you you don't think of it that way, then you might be making this gross planning mistake and just wait until 73 when they start requiring minimum payments on that bill. It is obviously a bill that is owed. So we've got to factor that in.
Sure, yeah. I mean, and if you're in a 22% income tax bracket, $1 million minus 22%, as you make piecemeal withdrawals out of that. Yep. Again, yeah, a millionaire on
780,000 ish or so, right?
Yeah, yep. A million on paper might not be a million when you walk into the bank to make the deposit. But yeah, but again, congratulations. Still, a seven-figure IRA is
Sure.
certainly nothing to make fun of, and forgive us for that, folks. Just good disciplined savings, and as people have been able to work longer and the executive powers that be in Congress and the Internal Revenue Service, they have broadened out and increased the amount of money that American workers can put into their retirement plan. So obviously the balances get higher as well because they have different places to shelter that money from taxes then, but not taxes, and then pay taxes later.
Now, you mentioned you yourself, Chris, have multiple different types of money, types of accounts, traditional, Roth, life. Is that suggestible? Do we need to have a variety of different styles of money, different kinds of tax qualifications for retirement?
Oh, absolutely. Because if you think about it, you diversify your investments for, managing risk, right? You got safe money, you've got some low to moderate money, and maybe some higher risk dollars for long term and to combat inflation. And, the allocations in those buckets change as you get older. Then why wouldn't you want to diversify your tax strategy as well? So, yeah, it would make sense for a lot of folks, again, depending on your age and how long you're going to work, to have money in different buckets for flexibility. I'll give you a good example. Wife and I ordered a new vehicle not too long ago, and we're going to pay cash for it. Hey, I don't have to take that money out of an IRA, so don't need to add 22%,
Mm.
federal tax, 4% for the state, and if I live in a municipality that has income taxes, may have to pay another 1, 2, 3% on top of that. So it's easy just to write the check for the amount on the invoice.
Well, and you mentioned that in retirement, Chris, those withdrawals might also impact Social Security taxation and Medicare costs, the premiums, and the capital gains rate. It sounds like, do you find that retirees find that taxes are more complicated in retirement than they were during their working career? It seems easy when you just earn a paycheck and taxes are withheld and then you file.
Yeah, because somebody else is taking care of all of that for you. It isn't easy. It's just that somebody else is doing it. And then in your retirement, you have to manage, the tax brackets you're in, right? We have a 10% tax bracket, a 12, a 22, and then I believe it's 24 after that. So, pretty good jump from 12% to 22. And that's in that, by the time you factor in your standard deductions and whatnot, right? Because that's the nice thing. We get a standard deduction to help simplify our tax uh, filing because, they just say, look, here's your standard deduction. You don't have to worry about itemizing if it's less than that number. We're going to give you this number. And then that first part of your bucket is taxed at 10%, the next at 12, the next at 22. It depends on your filing status. That's why we're not giving dollar amounts because if you're a single filer, married filing jointly, married filing separately, all of those things come into play too.
Well, I've heard people say, it's a goal to pay no taxes. I think that's pretty much impossible, if not illegal. And besides that, Chris, paying taxes, yes, I still hear the word problem, but it is a good problem to have. I'd rather have income, have assets, and pay taxes than not have income or assets. It's just that we want to be as effective as possible. And that's why you have repeatedly on this program encouraged people to take a proactive look at tax planning. That's really the secret here to addressing our largest likely known expense in retirement taxes is have a proactive plan.
Yeah, it certainly is. And, especially toward the end of the year, like we do a lot of Roth conversions here in the month of November, early part of December. We're really approaching the cutoff dates to do any of those things now by the time the end of the year comes. Um, Everything right now is focused on required minimum distributions, and then again managing the taxes. Because we get clients that we may not be involved in their tax planning strategy because they have their own CPA or something like that, and they'll say, "Hey, I need 50,000 out of my IRA. How much in taxes should I hold?" Said, "You need to contact your accountant on that, because if we're not directly involved in it."
Yep. Well, again, if you'd like to get that proactive, comprehensive plan put together, addressing life and living expenses as well as your largest expenses in retirement, then pick up the phone, give Chris McIntire a call. Effective tax planning, by the way, is as effective as shooting for higher returns, but generally with far less risk. You get to keep more of your money legally, ethically, and without the risk of the market. So be effective, be proactive in your planning, especially in that tax planning. Get a game plan for retirement. Chris McIntire offers to put that together with you, for you, no cost, no obligation. Just pick up the phone and give a call to get the conversation about that started. 800-868-1194. That's 800-868-1194. On to expense number 2, Chris, our largest potential expense. And yes, it is just potential, but we should all have a plan for this because without preparation, this one could absolutely be catastrophic. The potential cost of healthcare, which, by the way, statistics show many of us are going to encounter more than anticipated.
Absolutely. And, healthcare, I think the rate of inflation on healthcare far exceeds what you're getting in your cost of living adjustment for Social Security, because cost of living adjustments include many other items, not just healthcare. And obviously when it comes to healthcare, my wife and I pay over $2,000 a month for health insurance. Okay. And then, she'll transition into Medicare here toward the end of the year. I'm sure she wants everybody to know that. And but there's also the long-term care side when it comes to healthcare, right? If you spent some time in a nursing home, for example, at $8,000 to $10,000 a month, or even assisted living, these places are incredibly expensive, and many people have yet to plan for it. We are seeing more and more activity within our client base because they're caring for aging parents, and they see the costs and whatnot and the time associated with it. So, please take some time. This is a gap that millions of Americans just, refuse to deal with, I guess.
Yeah, but the reality is that even with a otherwise well-laid financial and retirement plan, unaddressed potential cost of care can be catastrophic, as Chris mentioned the numbers. But Chris, I mean, even just regular copays and deductible, and hearing and vision and dental expenses, they all must be accounted for in a plan. These all must be planned for in order for us to have lasting financial confidence. Careful planners plan for care.
Sure. Yeah. You think about this, so you file for Medicare, and, and out of your Social Security benefit, for those of you that get Social Security, right? In Ohio, we might have teachers that don't have Social Security, but you're paying for your Medicare premiums regardless of whether you get Social Security or not. That's $185 a month going into 2025. Okay. So let's just call that 200 for easy math on a radio or a podcast. Okay. And then you have to get a supplement in your Medicare insurance to cover what the standard Medicare doesn't. So let's say that's another $200 a month. And then the prescription drug benefit, which could be another $100 to $200 a month, depending on the medication. So, plan for $400 to $700 a month, for healthcare expenses. And, for us, that's less than what we currently pay. For some people listening to the show today, their employers provided all of that. Now they've got some skin in the game. And you do have to factor that. If it's $700 a month, that's $8,400 a year times two. If you're married, $16,800. That's a significant expense, Peter.
Yeah, and paying privately significantly more than that. Chris, you and I both know that. And in fact, I think that one spills over into number 3. This is one that I think almost nobody has accounted for in their line item budget, but we certainly need to project this out into our future years of planning and expenses and projections, which is the silent thief, inflation. I am going to partner these two up. Healthcare, inflation, inflation has soared far more rapidly than almost any other category of expense.
Yeah, without question, it's caused a lot of let's call it economic carnage, across the retiree generation here, and it's something that we have to build in our plans for everyone, Peter. And inflation is just a beast out there for sure.
Does inflation impact retirees specifically harder than it does for working Americans?
Well, and let's take a look at that, Peter. Let's dive into that a little bit deeper. And where is the inflation hitting them the most? Right now, it's probably food prices. Okay. Previously, a few years ago, it would have been real estate prices. Some people wanted to buy a second home in Florida, and with COVID, everybody wanted to go to the Sunshine State. So real estate prices went up significantly. And here I live in Ottawa County, Ohio. And, we got our property tax assessments, and some of those are up 60 and 80% over last year. So property taxes then obviously go up as well. It's nice that the value of homes go up, but if you're a retiree and have no intentions of selling, now your property taxes are going to go up because it's unlikely that the local municipalities are going to, cut their property tax rates because of property tax increases proportionately. That typically doesn't happen unless you live in Naples, Florida. That's what they did.
Well, bottom line, Chris, inflation is going to be a constant factor. We've seen it spike. We've seen it before the recent spike. It was relatively low for a number of years, almost a decade, with relatively little inflation. But on average, over the last 100 or so years, it has been above 3%, like 3.5%. And yet a lot of retirement plans do not factor inflation in to the projections. They sort of assume this flat need for income. We know inflation is a fact, and Social Security's cost of living adjustment is almost never going to truly account for real cost of living increases. The COLA does not truly account for real inflation.
That's right. Yeah. And in the United States, they don't use food and fuel in the calculation for, in the consumer price index because they are so volatile. So, the real rate of inflation is only felt typically when you go to the grocery store and to the gas station for most Americans, and then obviously to the pharmacy counter as folks get older and they take more medications typically. And, unfortunately, we have a healthcare system that they reward the pharmaceutical industry more than they reward people who for taking on healthy lifestyles. And I'm a pretty big advocate for that.
Well, ladies and gentlemen, there really is only one way to combat the possibility of expenses potentially catastrophically exceeding the income producing ability of your retirement assets, and that is to have a carefully crafted written retirement income plan. That is the game plan for retirement, taking all expenses into account. You must understand both your baseline operating cost and the additional expenses that you will encounter, and have a reliable plan for continued financial security and stability. And that's exactly what Chris McIntire's game plan for retirement strives to help his clients have that sense of lasting financial confidence in covering those expenses. If you would like to get a game plan for retirement put together, pick up the phone and give McIntire Retirement Services a call, 800-868-1194. That is 800-868-1194, 800-868-1194. You've got to have that plan in place for this year, next year, and all the years beyond for lasting financial confidence. Chris, I know that you take very, very careful steps and great pride in helping your clients put those together.
Yeah, absolutely, Peter. We help them go through a lot of different difficult decision making in their retirement, from retiring, what to do with 401ks, pensions, to the loss of loved ones as well. And we're ever grateful. And thank you for listening today, everybody.
Again, give Chris McIntyre a call to get that process started. By the way, it's not a one-time thing. It's a continued process, an ongoing planning process. But to get that started, pick up the phone, give a call. Chris McIntyre, McIntire Retirement Services, the game plan for retirement, 800-868-1194. That's 800-868-1194.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.